Hello, in today's video we're going to be taking a look at the Friday, October 3rd, 2025 trading session for the SPX CBOE index. And we're going to be looking at utilizing the day trading GPS, SPX Daily Key Levels indicator, specifically the newest version of that indicator that was released about 2 weeks ago, the V2.0 version. Okay, so many of you may be already familiar with how this indicator works, but for those who may be not familiar with it, I will briefly go over how this indicator works. So at 9:30 a.m. Eastern New York time, when your chart is on the CBOE SPX index on TradingView, you will get the new levels for the session appearing on your chart in a couple different ways. So here you have the line labels for each of the key levels for today's session, starting with the most important level for the session, which is the indicator's bull bear key price level, which is abbreviated KPL. So for this session it was 67.2244. You also have on the default settings, you have 6 main levels above the BBKPL and 6 main levels below the BBKPL. So you have those 6 levels above is R1 through R6, and the 6 main levels below are S1 through S6. Those are also shown here on this table, which you can disable if you wish to not show it on your screen. Here we have zoomed in primarily on the S2 level through the mid R2, R3 level. If you have all 6 levels on your chart, it's usually best to zoom out to, say, R3 down to S3 or R2 down to S2 to give you a more detailed look at the beginning of the session. Okay, so the other key levels that you have on your chart are represented here in this table, which is the PMH. The SPX PMH is the pre-market high. SPX PML is the pre-market low. SPX YDH is yesterday's RTH session high. SPX YDL is yesterday's RTH session low. And SPX YDC is yesterday's RTH session close. These are also important levels, especially when you have areas of confluence with the standard key levels on the chart, as you can see here and also here. This table is also optional that you can turn off as well if you do not wish to have it on your chart. Okay, so the main levels above the bull bear KPL are your take profit levels for entries that are taken off of the bull bear key price level. So when you have an entry signal that is triggered by the bull bear key price level, your main levels above and your midpoint levels above are going to be take profit levels for bullish entries taken off the bull bear KPL level. Conversely, the main levels below are going to be your take profit levels for bearish entries that are triggered from an entry signal, a bearish entry signal at the SPX bull bear key price level. In this session, we did have a bullish entry right off the bat. This is the 9:30 a.m. opening candle. We're on a 2-minute chart. This indicator works on time frames of between 1 minute and 30 minutes. Primarily, the time frames that you would want to use is for intraday trading are between 1 minute and 5 minutes, with if you look at most of the trading videos that we have on this channel, you'll see us most often use the 2-minute chart because that is our preference, and it's also the time frame that we've found to be the most reliable as far as signals at the beginning of the session as well as throughout the session. However, other traders may prefer a 1-minute chart, a 3-minute chart, a 5-minute chart, or 10-minute or 15-minute or even a 30-minute chart. So that's completely up to the individual trader. However, our recommendation is that you use a 2-minute chart. Okay, so on the opening candle here, you have a cross above. So you can see here the candle did open slightly below the bull bear key price level. So this candle opened up at 9:30 and closes at 9:32 since it's a 2-minute candle. And as you can see here, we have a cross above and close above the bull bear key price level. So in this case, you would enter a bullish entry based on this price action triggered by the bull bear key price level. One thing to keep in mind with this indicator is that you can take entries off of the other levels as well. So as I pointed out earlier, for entries that are taken off of the bull bear key price level, these levels then become your take profit targets for bullish entries. And conversely, on bearish entries taken off the bull bear key price level, the main levels below are your take profit levels for your bearish entries. However, you can take bullish and bearish entries off of these S1 through S6 levels as well as R1 through R6 levels as well. Those will predominantly come in later on in the session as opposed to the beginning of the session, where the bull bear key price level will be more your most prevalent level for taking entries during the initial part of the session in 90 to 95% of the sessions. Later on in this video, we will also have, for the final 25 minutes or so of this video, a whole section that will go over how to take bullish and bearish entries off of the other levels, the R1 through R6 and S1 through S6. And that section of the video will also go into the two types of entries, standard entries and more conservative entries, and how to tell the difference between the two and when you might want to use one versus the other. So that will be the last 25 minutes of this video. If you've seen many of our other videos but not have seen that part, you may want to skip forward to that part, because it is the last 25 minutes. Also, I do want to mention before we get into the rest of the video here that if you are interested in purchasing this indicator, all of our indicators are sold on a one payment for lifetime access basis. So you make one payment and then you have access to the indicator for life. And if you're interested in purchasing the indicator, you can email us at daytradinggps@gmail.com to request a discount promo code in return for taking your time for watching this video. So if you are interested, just send us an email at daytradinggps@gmail.com to request that promo code. Okay, so we have the 9:30 entry here on this cross above and close above the bull bear key price level. So we have our note here, 9:30 opening candle, crosses above and closes above the BBKPL. So the three options that you have for an entry off of the bull bear key price level on a bullish entry are: number one, either using an at the money SPX 0DTE option, that is the strike closest to the bull bear KPL, which on today's session, Friday, October 30th, is 67.2244. So that is going to be slightly less than halfway between 67.20 and 67.25 strikes. So that would be your 67.20. If this instead was, say, 67.23 something, then you would use the 67.25 strike. You can also consider 1DTE options if you feel more comfortable in using those versus 0DTE. We primarily use SPX 0DTE, and that is what we have outlined here with the prices from the data boxes for the different timestamps for entries and exits. But if you'd like to look at how this would have worked out with 1DTE options, then you simply would look at the 1DTE options for the same strikes for the entry as well as the exits, and then you can get an idea of what the difference would be, and you can do that on your own time. Okay, so in taking this entry here, like we said, this is your primary option, the at the money option. The other option that you have the other options that you have are two out of the money options, and how you determine from an entry at the bull bear key price level what those should be is you look at the first midpoint level above your entry level, which is in this case the bull bear KPL, and so your first out of the money option would be the strike closest to this midpoint, the first midpoint above the entry level. So that is 67.2832. That is slightly over halfway between 67.25 and 67.30 strikes, so that would be the 67.30 strike. Your final option would be the strike closest to the R1 level, which today is 67.3420. So that would be your 67.35 option. So that is how you would determine. We're not really in extreme volatility right now. We're more in the lower to moderate volatility range. If we were in extreme, very high volatility, these would not just be 5 strikes or 5 points apart. So that's why you would use the strikes that are closest to either this first midpoint level or the first full level above the entry level. So in this case, it just happens to work out to be, in this case, this is 67.20. In this case, this would be the 67.30. And in this case, this would be the 67.35. The one that we use the most often is just your standard primary option, which would be the at the money option, the 67.20. The entry price on the 67.20 option on the close of this candle. Remember, you're waiting for the close of the candle to make sure it is going to close above the bull bear key price level. You can enter on just a price cross above, but if the candle ends up closing below, then that would be a different signal. That would be a bearish signal. So it is most prudent to wait for the candle close. Now on the candle close, the price for the 67.20 option was $18.19. Now, how you determine your stop loss. So on a bullish entry, your standard stop loss is going to be the first midpoint level below the level that triggered your entry. So the first midpoint level below the bull bear KPL is mid BB KPLS1, 67.1656. Our recommendation and opinion is to use the standard stop loss whenever possible. However, with the new V.2.0 indicator, we also included auto plotting of the quarter levels, which are represented by QL. So those are your tight stop loss options if you prefer to use a tight stop loss. So on a bullish entry that is triggered by the bull bear key KPL level, your tight stop loss is going to be the QL below the BB KPL. So in this session, 67.1950. Just be aware that even though neither one of these stop losses were hit, neither the standard one nor the tight one today, that if you do use the tight one, then consistently, then you are going to get stopped out more often than using the standard one. So the trade-off is that if you do get stopped out with a tight one, you'll have less of a loss, but those are more prone to get hit. So just as long as you understand that. Okay, so just to recap again, On a bullish entry, your standard stop loss is the first midpoint below the level. So that, in this case, the level triggering the entry is the BBKPL. So it's the first midpoint below the BBKPL. Tight stop loss is the first QL below the level, which in this case is this level here. If this had instead been a bearish entry, if this candle had instead done the exact opposite, and we entered, let's say, a 67.20 put, if this was the exact opposite situation, then on a bearish entry from the BBKPL, your stop loss would then be the first midpoint above, because you're looking for price to continue below. So your standard stop loss in the case of a bearish entry of the BBKPL is your first midpoint above, and your tight stop loss is the first QL above. Okay, so normally you were looking for one of three things. So it's depending on what kind of trader that you are. So if you're just looking for a scalp, then you're looking for a one level move from the level that triggered the entry. So if you were just looking for a quick scalp, then you would get out when price, from this entry here, when price touches R1. So you would get out on the close of this candle here, because this candle touched R1 and we have the close. So this would be where you would get out on a scalp. If on a normal trading pattern that's not going to be scalping, then you want to minimally look for a 1.5 level move to a 2 level move as being the minimum. And that would just be trader's choice, just based on the context of the session as to whether you want to get out at the 1.5 level move or 2 level move. So that would be the point of decision for you for on a 1.5 level move or 2 level move to either close out 100% of your option positions, or if you're trading multiple contracts, to sell 70 to 90% of those contracts, leave runners, and adjust the stop loss on the remaining runners to at least break even. Your third option would be if you're trading multiple contracts and you don't want to close out 100%, and you don't want to close out any of them, or let's say that you do want to close out less than what you should be closing out if you're going to leave runners, is that you would still, even if you did not close out any, you would at the 1.5 level move or 2 level move, if you did not close them out, or you did not close them out partially and make adjustments on runners, then you need to make an adjustment on your stop loss to at least break even at that point, or break even plus a small cushion of say 10 to 15%. So that's up to every trader to decide for their risk profile, because you don't really know. In that case, if you're not going to get out of the 1.5 level or 2 level move, or you're not going to sell 70 to 90% and do an adjustment on the remaining runners on the stop loss, then you're looking to see if you're going to go 3 levels or 4 levels or even more, and then you would have to keep adjusting your stop loss as it goes up. But the most prudent thing to do is to just go out and close out 100% at either 1.5 or the 2 levels, or if you're trading multiple contracts, if you're trading enough multiple contracts where you can close out 70 to 90% of them, such as 3, 4, 5, 10, etc. contracts. If you're just doing 2 contracts, that's hard to do because there really is no 70 to 90%. There's only selling 1, which is 50%. So typically, if you're going to be trading multiple contracts, it should at least be 3 or more, ideally 4 or more. So in that case, if you were trading, let's say 4, you would sell 3 either here at the 1.5 or sell 3 here at the 2. Then you would adjust your stop loss on the remaining 1 contract to at least break even or break even plus to 10 or 15% profit cushion, and then you're looking to then keep adjusting it as it keeps moving up more and more levels, or it's going to not work out, and because price retraces and stops you out, and in that case the stop out on the remaining runner would be break even or break even plus at 10 to 15%. Okay, so moving along, at 10:40 a.m. you would close out here you could have closed out here when it hit 1.5 levels. So just so everyone's on the same page here, 1.5 levels is determined from the level that the entry was derived from. So the triggered entry level is the BBKPL. So a half level is this midpoint, a full level is R1, and then 1.5 levels would be the midpoint above R1. So you have a half level, 1 level, 1.5 levels. R2 would be full 2 levels above this level. So you could have done this here. We did it here on R2. When the R2 level hit, that's a 2-level move on the 10:40 a.m. candle close. The 67.20 call is now 28.75. Remember, you paid $18.19 on the close of the 9:30 a.m. candle. If you instead wanted to look at, normally in a lot of our videos, we also look at the other out-of-the-money options and what they would have turned into. I would invite you just to go back, and you can do that yourself by simply just looking at the, if you remember, the 67.30 option and the 67.35 call option, what those would have worked out to be on these different timestamps, and you can look at that on your own time. Okay, so you're out of this trade here at this point. So you're looking for another trade, or you're either A, hanging it up for the rest of the day and you have your profit and that's it for the day. However, if you are looking for additional trades, then you had another opportunity here at 11 a.m. for a bearish trade, because we're out of this trade here 100%. So now we can look at other opportunities because we're flat for the session now. We've already closed that on a profit, and now we're looking to see what other opportunity there may be. Here at 11 a.m. you have another opportunity here on this cross below and close below the R2 level. So this would be entry number 2. This was entry number 1 bullish, entry number 2 on a cross below, close below R2. So here you do the same process. Here's a cross below, close below. So you are looking at your primary option being the at the money option for the level that is triggering the entry. That is the R2 level. It is 67.45.96 for this session. So that would be, since it's a bearish play, the 67.45 put. If, just like down here, where we went over the 2 out of the money options, if you did not want to do an at the money option here, then the way you determine what your out of the money options are is you look up to one level. In this case, you're looking one level below because this is a bearish play. Down here, you were looking up to one level above because it was a bullish play. So here, you look at the midpoint level below it, 67.40.08. So your first out of the money option for consideration is the 67.40 put, or you're looking at the 67.35 put based on this one level here. So we've just gone ahead with the standard option here, which is the at the money option, the 67.45, and the price of that option on this close here on this candle at 11 a.m. is $8.20. Now, as we went over earlier, now this is a bearish play, so your standard stop loss is going to be the first midpoint level above the level that the entry was derived from. So the entry that was triggered from this R2 level, so it's simply the first midpoint level above, which is the mid R2, R3, 67, 57, 73. Your tight stop loss, if you prefer to use that, is going to be the QL above R2. Now we turn these two levels on. Normally by default these two levels are not on. The levels that are on by default are going to be your pre-market and yesterday's RTH levels, and your main levels S1 through S6 and R1 through R6, and then your QL above the BBKPL, your QL below the BBKPL, and your first midpoint above and below the BBKPL. And it's designed that way because that normally at the beginning of the session, that's where you're going to see 90-95% of your trades are going to be based on that. However, in the inputs, you can turn on whatever other levels. If you prefer trading off of other levels, you can turn these off if you want, and you can turn on other levels. So it's completely up to you how you would like your screen to look and what levels that you want turned on. You can also turn off, say, S4 through S6 and R4 through R6, or you could just see R1 and R2 and S1 and S2 plus the BBKPL. So that's completely up to you. That's all gone over in our setup and features video. After you purchase the indicator, we send you a link to that video. However, if you would like to request to see that before purchasing the indicator, just to get an idea of all the features and inputs of the indicator, you can, when you're sending us an email for the discount promo code, you can also ask us to send a link to that features and setup video, so you can take a look at it before you make your purchasing decision, if that's your preference. Okay, so tight stop loss here, first QL above the entry, the level, that the level was derived from, and the standard stop loss, first midpoint above. As you can see here, price did dip down and retrace back up above the level. However, it did never touched the QL tight stop loss nor the midpoint. So neither the standard stop loss nor the tight stop loss was touched on this entry. Neither was it touched down here on the bullish initial entry. Now, if you had missed this entry here, or didn't want to jump back in the market later, and you came back down and you saw this candle here, where we get a, remember this is the cross below, close below, okay? And then here you have, and we haven't breached these stop losses, and you have another cross below and close below. This is actually a much more fierce candle here, a lot longer candle, and this is at 1 p.m. So if you missed this entry here, there was another entry here which you could have gotten in. It's the same stop loss levels. And why is that? Because it's the same level that the entry, bearish entry, is derived from. That's the same one here. So it's the same stop losses. Or you could have added to your position if you were already in and you felt a need that you wanted to scale in more. Then after seeing this long candle, you could have scaled in and added. Here, the price on the close of this candle here for the same option was $7.40. Here, over here in the profit, though, we're just going off of the initial entry, not this entry here. Okay, so same thing. You're looking for, if you're, excuse me, if you're just scalping, then you would get out here when it hits R1. So if your entry was here, a one level move down is from R2 to R1. So you're getting out on the close of this candle if you're just scalping. If, like we talked about, you're looking for the normal move and you're not scalping, that would be the 1.5 level move or 2 level move being the minimum. So here you have, here where it touches on this candle here, the 1.5 level move. You also have it again here, and you also have it again here. However, we've done the 2-level move just like we did here, and this 2-level move occurs when it hits the BBKPL level, because R2 is 2 levels above the BBKPL, so R2 to BBKPL is a 2-level move. When it hits the BBKPL here at the 146, you're closing out, and the price on this candle close is $24.60. So you paid $8.20, you're out at $24.60. If you did do an adjustment, like we talked about earlier, of the 1.5 or 2 level, and you were still in, you had still runners in the trade or done an adjustment to your stop loss, then you got an opportunity here. This was a 2.5 level move, this 2-level move here, then the midpoint below on this candle here, which also happens to take out the pre-market low and yesterday's daily close level, along with this mid-level as well, all in the same candle. And then here, finally, you got the full 3-level move in the candle here below. So if you look at this level here, 67.22, and then S1 is 67.10, probably on this candle close here, you're looking at this being worth probably closer to 40. So just to give you an idea that if you had runners and you were looking for getting out these lower levels, or you had adjusted the stop loss to break even and you were waiting for either a touch of the 2.5 or 3 level move, then as you can see here, it almost made 3.5 levels. Then that just gives you an idea of how that would have worked out. Okay, so over here we just have a recap of the price per option page. So buy price on trade entry 1 here, the bullish, off the 9:30 a.m. cross above, close above. 67.20 call option, $18.19. So that's $1,819 per call option on the SPX 0DTE options on buying on the candle close of this cross and close above. So that's one option. So if you are not familiar with how options work, you basically take the price of the option, multiply it by 100, and that's your price for the per option. So 100 times $18.19 is $1,819. So for example, if you traded 5 of these, you would multiply that by 5, and so that would be roughly $9,000. If you were trading 10 of them, that would be $18,190. Okay, so here when you're getting out here at 1040, 2875. You subtract the 1819 from 2875, and you have 1,056 profit per option. So if you were trading 5, that would be roughly 5,250. If you were trading 10, 10,560. If you're just trading one contract, then that's $1,056. That does not include any commissions you may have paid to your particular broker for the in and out of the transactions. Okay, so trade entry 2 is the bearish trade entry here. We're just looking at the first one, not the second one. So the first one, the buy price was $8.20 on this 11 a.m. candle close, cross and close below the R2 level. So that's $820 per option. So that's for one option. If you were trading 5, it would be roughly $4,100. If you were trading 10, it would be $8,200. So here on this 2-level move, where it hits the BBKPL at 146, then so that's roughly 2 hours and 46 minutes later from the entry. So we have we're out at 2460, and so we paid $820. So that is a difference of $1,640. So the total profit for the session, $2,000 $696 per option if you took both trades. If you didn't take both trades, and let's say you just took the first one, then $1,056. If you didn't take the first one, and you instead were just the kind of trader that's looking for opportunity later in the session, then that would have been your profit. Okay, so what we're going to do now is we're just going to go to the final section, which I brought up earlier, which is the section that is going to be about 25 minutes long, that goes over how to take more in depth how to take bullish and bearish entries off of the other main R levels and main S levels. So that's going to be your R1 through R6 or S1 through S6 levels. And then it's also going to go over the two different types of entries, the standard entry as well as a more conservative entry, and what to look for in both of those types of entries, whether they're bullish or bearish. Okay, so now we will go to the next part of the video. This part of the video was pre-recorded a few weeks back, so I hope you enjoy the rest of the video, and we will move on to that part now. Hello, in this video we're going to go over how to take trades off of the other main R and S levels. So this would be taking trades off other levels besides the bull bear key price level. So the main R and S levels are your R1 through R6 and S1 through S6. So if we zoom out here, we'll have R1 through R6, S1 through S6. The levels that show up as default on startup with this indicator are the PMH, PML, YDH, YDL, and YDC. So that's the pre-market SPX pre-market high, SPX pre-market low, SPX previous day RTH session high, SPX previous day RTH session low, and SPX previous day RTH session close. So the previous days are YDH, YDL, and YDC. So that's yesterday's high, yesterday's low, yesterday's close. PMH and PML are the current session's pre-market high and pre-market low. So pre-market high, pre-market low, YDH, YDC. We move down, here's the low from the previous RTH session. Also in startup, you will have R1 through R6, the bull bear key price level, and S1 through S6. You will also have QL above BBKPL, QL below BBKPL, the first midpoint above the BBKPL, and the first midpoint level below the BBKPL. And this is because in 95% of the sessions or so, your trades at the beginning of the session, if you decide to take trades at the beginning of the session, are primarily going to be based on price action at the bull bear key price level. However, there is no rule or obligation to take trades off the BBKPL. It is there for the session bias, to give you a bullish or bearish bias for the session, as well as the trades that you can take at the beginning of, like I said before, 90-95% or so of most sessions that you will see. However, you can just wait until price action bears out further on in the session and take trades off of the main R levels or S levels. As we've discussed in other videos, when you're taking a bullish trade off of the bull bear key price level, your tight stop loss is the QL below the BBKPL on that bullish trade triggered from the BBKPL level, and your standard stop loss is the first midpoint below, which would be mid BBKPL S1 for for a bullish trade taken off of the BBKPL level. Conversely, on a bearish trade taken from the BBKPL level, your tight stop loss is the QL above the BBKPL, and your standard stop loss for a bearish trade taken off of this BBKPL level is the first midpoint above the BBKPL, which is mid BBKPL R1. The same principles applies to taking trades off of the other levels. So if you're going to be taking trades off the other levels, then you simply need to turn on the quarter levels if you're going to be considering taking tight stop losses, or the midpoint levels for standard stop losses. So for example, if we're looking to possibly take bullish or bearish trades off of R1 or R2 or S1 or S2, then we would simply turn on the QL levels above and below those levels, as well as the midpoint levels. So you simply go into the user control panel, and first we'll turn on the midpoint levels. So we'll enable mid R1 R2, mid R2 R3, mid S1 S2, and mid S2 S3. And let's say we're also considering tight stop losses. Then enable QL below R1 and above S1, below R2 and above R2, and then the same thing for the S levels. Above S1, below S1, above S2, and below S2. Now you can leave it this way if every day that you want to consider taking trades off of this level. Just know if you reset the settings, it's going to go back to what I showed you before as the default. So for example, right now we're just showing R3 through S3. So for example, if price is coming down to S1 and bouncing off of S1, and you want to take a bullish trade off of S1, then your tight stop loss on a bullish trade is the first QL below S1, because S1 is the level that you're taking the trade off of. And the standard stop loss would be the first midpoint below S1, which would be mid S1, S2. So instead of a bounce off of here, if price came below here, then went back up and crossed above and closed above S1, and you wanted to take a bullish trade off of S1, it would be the same thing. You're taking a bullish trade off of S1, so your tight stop loss is the QL below S1, and your standard stop loss, if you choose that one instead, is the first midpoint below S1, mid S1, S2. Let's say the reverse happened. Price is slicing through S1 and closing below S1, and you want to take a bearish trade off of S1. Then on a bearish trade from S1, your tight stop loss is the QL above S1. And on a bearish trade on S1, your standard stop loss is the first midpoint above S1. So always just remember that on bearish trades from any level, your tight stop loss is going to be the first QL above that level, and your standard stop loss is going to be the first midpoint above that level for bearish trades taken from that level. And on bullish trades taken from any main level, your tight stop loss is going to be on bullish trades taken from the main level, your QL below that level, and your standard stop loss is going to be the first midpoint below that, whatever level that is. So on R1, If we were taking a trade of a breakout above R1 and we're taking a bullish trade, then our tight stop loss is the QL below R1 because that's the level we're taking the trade from. And our standard stop loss, if we choose that instead, is the mid BBKPL R1 because that's the first midpoint below the level we're taking the bullish trade from, R1. If we were taking a bullish trade on a breakout above R2, then our tight stop loss in that bullish trade on a breakout above R2 is QL below R2, and our standard stop loss on a breakout above R2 is going to be the first midpoint below R2, which is mid R1, R2. Now, in the reverse, let's say that price goes up to R2. Now it starts closing below R2, and we're looking for a bearish trade off R2 to move down below to these levels below. On a bearish trade from R2, then our tight stop loss is the first QL above R2. If we choose instead to use a standard stop loss for our bearish trade taken off R2, then the standard stop loss is the first midpoint above R2, which is mid R2, R3. Same thing if we're taking a bearish trade off of R1. If we're looking for a bearish trade off of R1 or break below R1 or a touch and fall off of R1, then our tight stop loss on the trade taken from the R1 level is the QL above R1, and our standard stop loss on this bearish trade taken from R1 is the first midpoint above R1, mid R1, R2. Same thing applies to the S levels on bearish trades. If you're taking a bearish trade based on price action coming down, closing below S1, then your tight stop loss in that bearish trade taken from the S1 level is QL above S1, and your standard stop loss is the midpoint level, the first midpoint level above S1, which is this mid BBKPL S1. On a break below S2, then a bearish trade taken from S2 is the tight stop loss for that. On a bearish trade taken from S2 would be the first QL above S2 here, and your standard stop loss would be the first midpoint above S2, which is mid S1, S2. Same thing applies on S3 levels. If this was a bearish trade we were taking because price started closing below S3, so on a break below, close below S3, our tight stop loss would be the QL above S3, which we don't have because we didn't enable it on this chart, but it would be the first QL above S3, or if instead you're choosing to take the standard stop loss for your trade on a bearish trade from the S3 level, then it's the first midpoint above S3, which is mid S2, S3. Same thing for a bullish trade above R3. Break above, close above R3, then your tight stop loss would be the first QL below R3 because we're taking a bullish trade looking for price to go up, continue going up. So you would enable QL below R3 if you want to use a tight stop loss. Keep in mind that if you're just using standard stop losses, then unless you have some reason why you want to see where the QL levels are, there's no reason to turn them on. So if you're just going to be using the standard stop losses, then you would just want to have your midpoint levels turned on, unless for some reason you also want to see, just for context, where the QL levels are. So again, in summary, if you're taking a bullish trade off of either the bull bear key price level or any main level, whether it's an R level or an S level, if it's a bullish trade, then your tight stop loss, if you choose to use that, is the first QL level below the level that you're taking the trade from, and your standard stop loss is the first midpoint level below the level you're taking the trade from. The opposite is what is on bearish trades. On bearish trades, then if you use a tight stop loss, then it's the first QL level above the level you're taking the trade from. If you're taking a bearish trade and want to use a standard stop loss level, then your standard stop loss level is the first midpoint above the level that you're taking the trade from, the bearish trade from. Bearish trade from R1, standard stop loss is mid R1, R2. Bearish trade off of R2, looking to go down, your standard stop loss is mid R2, R3. Bearish trade from the BBKPL, your standard stop loss is the mid BBKPL R1 because that's the first midpoint above it. A bearish trade taken from the S1 level, your standard stop loss is the first midpoint above S1. And again, on bullish trades, it's the opposite. It would be the first midpoint below. So if you're taking a bullish trade off of S2, first midpoint below S2 is your standard stop loss. Okay, so now we're going to take a look at examples of both standard and conservative entries, both on bullish entries and bearish entries. So first off, we're going to look at bullish entries. So here we have a cross above and close above. So we have a candle that the same candle is crossing above the level in question, in this case the bull bear KPL, but it would not matter what level it's on. So regardless of what level this is, you have a cross above and close above the level. That is your bullish entry on a cross above and close above the level in question. Your second option is take a more conservative bullish entry approach. And on the more conservative bullish entry approach, you are requiring a retest of the level, a successful retest of the level before entering your trade. So in the case of a bullish trade, you're waiting for a successful bullish retest of the level in question before entering your bullish trade. So on this more conservative option, the sequence is you have a cross above and close above the level, which we have here, followed by price falling back to test the same level successfully, meaning it's coming back down, it's not closing below the level, it's successfully retesting the level and closing above the level. So it's cross above, close above, fall back to retest on a bullish trade, close again above that level. That is your conservative bullish entry that requires a retest. Just keep in mind that if you are going to focus and use the more conservative bullish entry that requires a retest, that many times price, after initially crossing above and closing above, will just continue to keep closing above in successive candles, and there will be no retest. So just keep in mind that if you use the more conservative entry, there are going to be times where you are going to miss entries because there is not going to be a retest. In this case, there was a retest. So again, just to go over it again, the standard bullish entry is a cross above and close above the level in question, in this case the BBKPL. So you would enter on the close of this candle here. Or if taking the more conservative bullish entry approach, you're waiting for a successful retest for price to fall back to the level in question, but still close above the level in question. And that is your successful retest. So you would enter You could have entered on this candle, or if you did not on those, you could have entered on this candle here, and it did retest the candle here. We had a retest here, but if you waited for this retest, you'd be paying a lot more. So usually the successful retest, you're just waiting for the initial successful retest. So this is the initial successful retest. This is the initial cross and close above. This is the initial retest. Okay, so just to take this one step further here, so as you can see here on the R1 level, we had a cross above and close above this level. So if you missed this entry here, or if you're just the kind of trader who you prefer taking trades off of other levels besides the bull bear key price level, then you have a cross above, close above here, and you would take that entry here, and you would base your entry on the R1 level. Now, just to clarify, the stop loss on either one of these entries here, down here, whether you took this standard bullish entry or the more conservative retest required bullish entry, your standard stop loss is the first midpoint level below the level in question you're taking the entry from. So in this case, on this sequence here, this is taken from the bull bear KPL, so your standard stop loss is the first midpoint level below the level in question, the bull bear KPL, so that is this level here. We don't happen to have the quarter levels on this particular chart, but if you instead wanted to use a tight stop loss level, then you would enable the QL below the bull bear key price level, and that would be your tight stop loss on this trade. And the QL is the midpoint between the midpoint and the main level. So on the new version, the 2.0 version, you have the auto plotting of the QL levels if you simply enable them. But here, as you can see, the tight stop loss would not have been hit either. But just keep in mind that on any entries, whether it's bullish entries or bearish entries, and the tight stop loss is named a tight stop loss because it is tighter and there's more chance that it will be hit than the standard stop loss. So if you're going to use the tight stop loss, you're going to have less at risk because you're using the tighter stop loss. But conversely, the con side of that is that there's more chance of it getting hit. So you just have to be mindful of that. If you instead, like the second point we're getting at, if you waited to take an entry off of the R1 level on this cross and close above, then your standard stop loss on that trade is the first midpoint below the R1 level, which is this mid BBKPL R1. And if you instead took the tight stop loss, then it would be the QL below the R1 level, which would be the midpoint between this level and this level, which again, on the new V2.0 indicator, those auto plot as well, the QL levels. Okay, now we'll look at a bearish entry. Your standard bearish entry, you enter a bearish trade on a cross below and close below level. So here we have a cross below and close below the R2 level. So you would enter a bearish trade on this cross below and close below if you were looking to take a trade off of the R2 level and you were open to bearish trades off of that level. This would be your signal to take the bearish trade on a standard bearish entry. Your standard stop loss on this bearish entry is the first midpoint level above the level you're taking the bearish entry from. since the bearish entry is from the R2 level, your standard stop loss is the first midpoint level above the mid R2, R3 level. And if you chose instead to use a tight stop loss level, then it would be the QL above R2, which in this case would be about right here. And again, on the new V 2.0 indicator, it will auto plot that level for you if you go ahead and enable it. Now, looking at the more conservative bearish entry, it's just like the bullish one that we did, except in reverse. We're waiting for a successful retest of this level before entering the bearish trade. So in this sequence, it's basically the reverse of this sequence down here for the bullish entry. In this sequence, we have a close below candle. Then price rises back up to test the level in question and then closes below that level again. That's a successful retest of the level. So this is where you would enter on a successful retest. You could have also entered here. That would have been a little bit later, but that, either one of these candles here would be considered the successful retest. So even on the successful retest, since it's off of this level, it's the same stop loss. First, for a standard stop loss, the first midpoint level above, which is mid R2, R3, that's the first midpoint level above this R2 level. And if you chose to use a tight stop loss, it'd be the same as what we talked about with the standard entry. It would be the QL above R2. And the same thing would apply for any other level. So if this price action was happening down here on this S2 level instead of here on this BBKPL level, then it would be the same sequence. Cross above, close above, that's your standard entry. Cross above, close above, then retest and close back above, that's your conservative successful retest entry. And then your standard stop loss on an S2 level bullish entry is the first midpoint level below S2, which is mid S2, S3, and then your tight stop loss level on a bullish trade taken from the S2 level is your midpoint, the QL below S2. Okay, I hope this clarifies the entries and also taking entries from the different levels for you. Thank you.